Recording and you'll share my screen. Oh
There you
yeah, I
go.
can. Yeah. Today's gonna be a fun one. We are not talking any project specific stuff today. We're gonna go back to general trading. So I know the last two events have been more project focused. We talked about addicted.fund and like the stuff that they're trying to do to solve sustainability for Ponzi-fied games. And they're still around, so that's definitely one that we can still look at later in the future because they're still kicking and they're still building on Solana. And then not last week, but 2 weeks ago, last event, went ahead and talked about Ora Chain and LFG and what they're building with the AI layer and the perp decks that they're creating on mobile. Um, so if you guys, any of you guys went ahead and participated in that pre-sale, let me know. You know what you guys are thinking and how their development is going. I've been keeping my eye on them and have the X noties on, so I do have my eyes on what they're cooking. But today, like I said, we're going back to general trading and talking about time frame charting and how it dictates how you trade. This is an interesting one because it sort of starts combining everything that we've talked about so far into okay, now that you've learned, piece A, piece B, C, how do you bring that all together and actually start implementing that into your trading strategies? So we're going to talk time frame charting and how that helps you trade. So, first things first, going to get right into it. Why time frames matter. So the main idea of this event today is going to be every trader sees a different story depending on what chart they're looking at. What does that mean? Here I put the 1 minute chart. I know some people put it on the 1 second chart, but I think the 1 minute chart is like a good degen place. The 1 minute chart shows emotion. It shows people trading live. People are buying, people are selling. You're looking at things happening on the moment as real time as you can get. And this chart is really what I put here reactionary. You're reacting to momentum. You're not waiting very long to go in and out of trades. You're reacting to what you're seeing right there on the spot, and you're not looking away from the screen. This is what 1 minute charts look like, and it's all about emotions. What you're seeing, there's a bit of charting, there's a bit of are we up, are we down, but it's really more about like seeing what's happening in real time and reacting to it. 1 hour charts actually now it gives you a little bit more room to breathe because it only creates one candle every hour. So this becomes more about rhythm, momentum. Okay, what happened throughout the day? This is for day traders. Day traders, 1 hour, 4 hour charts is like where you live and breathe because this gives you enough information to then be able to zoom in into something like the 15-minute chart. So 1 hour, 1 minute reactionary, 1 hour momentum and rhythm. And then the 1 day shows you directions. Because if you zoom out all the way to the 1 day charts, you start seeing, uptrends, you start seeing downtrends, you start seeing whether we're in a mini bull market. Is the market feeling good this month? Is the market feeling bad? This is where you start getting analytical. You start looking at more analytics and more things to look at because you're not looking at the 1 day chart to open a 1 day trade. You're looking at the 1 day chart to open a multi-day, multi-week, multi-month trade. Right. And now to put all that into a simple example, a 1 minute chart might look bullish, but if you zoom out to the 4 hour chart it's still a bearish pullback. And this is where it gets really interesting when we talk about time frames because they all tell a story, but they might be telling contradicting stories. And this is why zooming out is always it's always better to start zoomed out and then zoom in as you need. Because if you start zoomed in and you come up with a narrative in your head and then you zoom out a couple times and found out that that narrative is wrong, most of the times it's going to be a not great trade because you're doing something that may be contradicting what the rest of the market feels. Right? That means the charts didn't change, your perspective did. That's a nice little thing there to remember. Just because you're zooming in and out of charts, it doesn't mean that the narrative and the way that the trend is going has changed. It's just your perspective of the chart. So let's understand the time frames a little bit more here. So as we remember, candle, all it means is an indication of a period of time. You know, whether you have a one candle on the 1 minute chart, that's 1 minute. If you have one candle on the hour chart, that's 1 hour. One candle on the day chart, that's 1 day. All the only thing that it candle means is just a certain amount of time has changed, and then it gives you a bunch of information about what happened in the market during the candle. More candles does tend to equal more noise. Fewer candles allows you to create a clearer trend. And this means more of like, if I zoom out into the day chart and I just look at the price action over a week, that's 7 candles in that 1 week on the day chart. But if I try to get the week picture on the minute chart, that is a lot more candles than just 7, because now you're multiplying 7 times 24 for the hours times 60 for the minutes. So you're having a lot more information, and it just creates more noise. It's hard to see what the trend actually looks like. Fewer candles, zoomed out a little bit more, it's clearer to see the trend, it's clearer to see what exactly is happening in the market, and you're able to create a better idea for your trading. Rip asks, how do people trade on the 1 second chart so well? The best traders that have traded on the 1 second chart are that I know are people who have volume, and then they go trade in places with low liquidity, because when you have a lot of volume on low liquidity, that means you're the one moving the markets. If you're the one moving the markets, it don't matter what the charts look like. You're the one making the movements, and everyone else is following along. Um, Whether that's considered market manipulation or not, that's outside of the scope of this event, and that's for other people above us to figure that out. Time frames are like zoom levels on Google Maps. And I put this here because I think that's like a visual way for all of us to think about it. When you're zooming in into Google Maps, you see a clearer picture, and you see like more of like what the picture is. But if you were to try to figure out what's happening on in your city, and you're zoomed all the way to your house, you're only seeing what's happening in your house, but you don't know what's happening across the street or down the road. But if you would happen to zoom out, you start seeing a better picture and an understanding of what's actually happening in your town. It's the same thing with time frames and charting. If you're zoomed all the way into the 1 second, 1 minute chart, you're only seeing what's happening in that specific moment. Once you start zooming out, you get a better picture of what's actually occurring. The young prof asks, why might a trade setup that looks profitable on the 1 minute chart fail when viewed on the 4 hour or daily charts? Easiest way to answer that is the thing that we just talked about. Yeah, at a 1 minute chart, it might look bullish. You might feel like, okay, cool. For the last 15 minutes, we're in an uptrend. I want to open up a long. But if you were to zoom out to the 4 hour or daily chart, you might notice that Bitcoin is crashing hard, and Trump just announced another tariff on China, and like everyone's panicking. So even though it's bullish on the 1 minute, if you zoom out a little bit, the world might be burning, and you are trading against the overall trend. That's the base reason of why things like that would happen. When you're zoomed in too much, you don't have all the context. Zoom out a little bit, and you start seeing more of the context of what's happening. Tech Dan says, I prefer dealing in the minute chart time frame. It's cool. If you're just trying to trade for like an hour or two, you zoom into the minute chart, you place a couple bets, you place a couple trades, and then hope that it goes your way. But if you're not going to be looking at your computer all day, and you're going to be trying to open up a trade for the next week or two, trading on the 1 minute chart is definitely a risky move. Right. The young prof also asks, how can traders avoid being misled by short-term noise when making long-term trading decisions? Zoom out. Just zoom out a little bit and make sure that you're making your overall analysis. If you can look at yourself in the mirror and say, we're in an uptrend or we're in a downtrend, those decisions should be made on the 4 hour or daily chart. Don't make those in the 1 minute chart. You're going to shoot yourself in the foot. And then here, just a little way of to give you guys a little chart. So if you were to look at the zoom level, the 1 to 5 minute chart is mostly for a scalper type of trading. And I say scalper not in a bad way. Like, scalping is a very profitable and legitimate way to trade, and this is where scalpers make the most money, because they're just going to be looking at the chart for a couple hours, trying to make a couple quick trades. And this is where a lot of people tend to use a lot of leverage, because in the 1 to 5 minute charts, the price isn't moving that much. So in order to actually make it worth your time, you up that leverage. You go outside of your 1 to 3 leverage, you go up to 5, you go up to 10. Or Terrace, I've heard you go up to 100, you know? That's where you start doing it in the super zoomed in charts, where you start going a little bit degen, start upping up the leverage to make more of your time. What it shows, the 1 to 5 minute level, it does show a lot of market noise, a lot of volatility, and it requires a very fast reaction speed. You going in there and trying to do multi-hour trades, it's only gonna shoot you the foot and you're gonna regret it. If you're gonna be doing the scalping zoom levels, you want to make sure you have a quick reaction speed. The 15 minutes to an hour chart, you have the day traders. This is where you think about, hey, I'm clocking in the morning for my day of work, having my sip of coffee. I'm gonna open up a trade in the morning and hopefully have it closed by the afternoon. This is what day traders are looking at. They're looking at the 15 minutes to 1 hour because it does show a couple things: short-term momentum and setups, and this is where you start thinking. This is where you start actually inputting some of the analysis that you create in the longer charts. You create your analysis on the day and the weekly and the 4 hour, and then you zoom into the 15 minute and 1 hour to start doing your day trading. And this is mostly where I spend most of my time. I create my support levels, resistance levels in the 4 hour to 1 day, and then I zoom in and play most of my time in the 15 minutes to 1 hour. Got a couple questions. We have, how can trade Thomas Benz mentioned that the 1 minute chart is reactionary and emotional. How do you personally protect yourself from getting sucked into the low time frame noise, especially when a trade is moving against you? It's a really good question. If It's hard because it depends on how you're looking at it. If you're opening up a trade that's a long on a bearish 4 hour chart, you know that you're going into it as a risk. Instead, you should look at it like, hey, if I'm going to be playing the 1 minute chart, I'm going to zoom out, get my general idea of what the market is feeling like today or this week, zoom in, and then start looking for opportunities that fit that sort of narrative. If your narrative is, hey, this month is October, maybe last month was October, that means that I should generally be looking for good long opportunities because the market and everyone else is telling me that it's going to be a good month. Obviously, that wasn't the case, but that's the general narrative, and that's how you zoom in into the 1 minute chart that's reactionary and emotional. And that's where you take advantage of, like, okay, cool. I'm generally looking for good opportunities for it to go up. Obviously, there's going to be an occasion where you have like a day of like, okay, all day today is going to be down because all these bad news happened, these things occurred. We had the FOMC and that didn't come out well. So for the next day or two, I'm expecting all the trends to be down and bearish. But now you zoom in with that idea in mind, and even though you know that's not going to be for long because that you expect that to be like a day or two, you'll look for short opportunities in those time frames. The young prof asks, how combining multiple time frames improve a trader's accuracy and confidence in the entries and exits? We're going to talk about that a little bit. It's like a Swiss knife. The more tools you have at your disposal, the more confident you can feel about your trades. How can you manage your stop loss and take profit levels depending on your time frame? It all comes back down to, well, stop losses and take profits has already been discussed extensively in a basic level, but it shouldn't change. If you're risking $10 every trade, that $10 should be in the 1 minute chart, 10 minute chart, 2 hour chart, 2 day chart. You should be risking $10 in every single chart. It just looks different on the charts themselves because you'll be using different leverage, especially if you're doing super scalping at like the 1 minute chart. Does time frame affect risk reward ratio? No, it shouldn't. But for a lot of people, it does because they think, oh, I'm gonna be zoomed in all the way to the second chart. I'm gonna up my leverage to 15 or 20x. That's why it affects people's risk reward ratio. But as a disciplined trader, it shouldn't. It doesn't matter if you're trading on the 10-week chart or the second chart. Your risk to reward ratio should stay the same all throughout. All right. And then just here to finish up this slide, the 4 hour to 1 day chart, that's when we talk about swing traders. So these are all terms that you guys have probably heard before, and this is how you define what kind of trader you are. If you're all the way zoomed in, you're a scalper. If you're working on the 15-hour chart, you're a day trader. This is where I identify the most between day trading and swing trading. 4 hour to 1 day chart are swing traders. You're looking for rhythm in market direction. This is where you get to multiple day, maybe a week or two trades. You open up something on a Monday, you look to close it on a Sunday. That's a swing trader. And then a week plus, that's when you start talking about investors. So anytime you see someone on the timeline saying, "Hey, I'm an investor, but I'm trading on the 1 second chart," tell them they're lying. They are liars. You cannot be an investor if you're in and out of trades within a couple minutes. You're a scalper, and that's totally fine. But investors are not looking for short-term gratification. They're looking for big trend, big picture trend. They're looking to find the next Amazon at $15 and holding that for 10 years and then cashing out because they held through all. The investors are people who bought Bitcoin 10 years ago and didn't sell a penny through the last bull market, the bear market, and this bull market. That's an investor. And we can all be investors because we can all hodl things, and that's the things that we're investing for. But if we're in and out and day trading and swing trading, we're not technically investors because we're looking at short term opportunities for a quick buck. We're something else. But we can all be investors if we have certain coins or certain projects that we're holding long term, regardless of the market conditions. How does shifting from a 1 hour to a daily time frame change your perception of market strength or weakness? The more zoomed out you are, the more right your analysis could probably be about the market sentiment. If you're trying to convince me that the market is bearish on the 1 minute chart, I'm gonna look at you like you're Delulu, because how are you gonna tell me that what the market is feeling when you're so zoomed in? But now, if you're looking at the day and the week chart, and you're telling me, "Hey, look, this year has not been a good year for crypto, or this year has not been a good year for gold," and you can show me that analysis on the 1 day to the 1 week, then now you're telling a believable story. But let's go on to the next slide, and these are some examples. So here on the top left, we have. And see if I can zoom in. Can zoom. I can. Oh, but it doesn't zoom in inside the slide. So you guys are all just gonna. Here on the top left, we have the 1 minute chart on Bitcoin. So what can you guys tell me? As looking at this chart, I'll just give you guys like 30 seconds. I don't want to spend too much time here, but what if you guys were to look at this chart, what are a couple things that you're able to see? And then also the same thing for here. So this is the 1 minute chart, this is the 1 hour chart, and this is the 1 day chart, all for Bitcoin. What things are you seeing between all of them? Be able to right click and copy. Aha! Look at Terrace with the alfalfa. Oh, but then it sends you. Oh, hold on. It just send the link. You lied to me. Well, first two go down, one goes up. Trend? Yes. Well, yes, the trend, and yes, the first two go down, and the third one does go up. Here on the 1 minute chart, depending on how zoomed in you are, here is choppy markets. Here is where you would start seeing yourself. Okay, I'm in a short-term uptrend, because you are. You're able to just over the next couple hours, you would have taken advantage of a lot of these trades. Open here or open here, closed here, opened around here, closed here, opened around here, closed here. Like that's what scalpers are doing. Just look for opportunities like this, and then this is just choppy markets. But then if you look at the hour chart, you will see what we've been seeing over the last couple weeks. If you want a snapshot of what the market has been feeling over the last couple weeks or couple months, this is from like the end of June to today. We go up, we go stagger, we come down. We go up, we go down, and then we come back up, and then we go down, and then we come back up, and then we go down. So that's pretty much 2025 for y'all. And we go up and we come down. We go up and we come down, and every time we're up, we say the bull market is back. Every time we're down, we're saying that everything's gonna go to zero. That is 2025 in a nutshell for you guys on the 1 hour chart. But if you're an investor, if you're one of those crazy guys out there like me, and you're holding no matter what, and you zoomed out all the way to the day chart, you will notice that Bitcoin is up, man. It doesn't matter like if you're zoomed in and you're feeling the worries of what happens this year. Look at that. Look what would have happened if you would have just add some conviction. I'm not saying that you should on everything, but when you zoom out, you get a better story. You start taking away the noise from everything that people are telling you on Twitter, YouTube, all the news and everything. You start seeing the truth because men lie, women lie, but numbers will never lie to you. And that's why I love math. Because numbers will not lie unless whoever's inputting the numbers is wrong. But if you were to just zoom out a little bit, you would see Bitcoin is doing just fine. Even if we dip a little bit, look how good we've been doing on the day chart. Now it just depends on when you entered. If you entered all the way up here, there's nothing for me to tell you. I'm sorry. If you bought at 120, I'm sorry. Just hold, hopefully. But that's understanding time frames and how like just a visual way to see everything we've been talking about. Rip asks, what time frame is the best for identifying overall market direction? Day and 4 hour. Simple as that. Day and 4 hours is really where you should be looking at market direction. If you're looking to hold long term, if you're looking to swing trade, maybe the 4 to the 1 hour chart. And then if you're trying to do day trade, 15 minutes and 1 hour. It just really depends on what kind of trading you're trying to do. And you should just make a note of that, and it goes to this. And this slideshow would be given to everyone and pasted here on the Discord so you guys are able to see. But just look at this chart and then tell yourself, hey, what kind of trader am I trying to be? And then depending on what you want to be between these four, look at the zoom levels, and this is why you'll want to use them. Right. And now we're going to talk about it a little bit further. Four trading styles and their time frames. We've already covered a lot of it, so this is going to be more just of like, hey, let's recap and then move forward. But scalpers, 1 minute to 5 minute chart is going to be your best friend, and sometimes even the 1 second chart. Not everything will have a good 1 second chart because, for example, like stocks, not a lot of people are buying stocks, on a second to second level, unless it's like Amazon or Tesla. But most stocks are going to have like 1 to 5 minutes is really where you'll be doing it. But crypto is decentralized 24/7, so 1 second to 5 minutes is really doing your holding period. So if you're trying to hold trades for seconds to minutes, you want to be a scalper because your goal is small but frequent moves. You want to go in and out, and try to, you lose one, but then you win three, you lose four, but then you win 10, and you're only trading for a couple hours because it's very intensive. You're looking at every movement and reacting to it. Thomas Benz asks, for a scalper living on the 1 minute to 5 minute charts, the rhythm or direction from higher time frames can feel irrelevant. What is the absolute minimum higher time frame context you personally check before entering a scalp to avoid being run over by the larger trend? Good rule of thumb. Obviously, there's always exceptions, but just check one time frame higher. So if you're a scalper, look at the 15 to 1 hour chart because that will tell you what the day trader is looking at and what kind of opportunities they're entering. So if the day trader is telling you the day is going to be a long day, zoom in and scalp for long options. If you're a day trader and you're like, hey, you know what, I'm going to be trading this whole week, Monday through Friday, I'm going to wake up in the morning, sip my coffee, and make some trades, ask the swing trader, hey, what does your analysis tell you? What are you looking for this week? Are you holding for a week to go long? Are you holding for this week to go short? The swing trader will be able to tell you what you should be looking at as a day trader. If you're a swing trader, you ask the investor, hey, what is going to happen this year? You think we're hitting Bitcoin to 150? Tell me, is Bitcoin 150 or 50K? And then take that with a grain of salt. Do your own research, obviously, and do your own charting. But that's how I would look at it. Thomas Benz. Just look one chart up or one style up, and then ask what that person would look like, and then use that information. It's a good rule of thumb. So that's the scalper, day trader, 15 minutes to 1 hour. This is intraday. So you're clocking in at 9, closing shop at 5, and you're opening up trades in between. This is to catch short trends. You're not leaving trades open overnight. You're closing them by the time you get off. Swing trader. This is where you're opening up a trade on Monday, checking it in on Friday, or opening up a trade on November 1st, and then checking it in at the end of no, not November. This is what a swing trader looks like. You ride larger waves. You're holding between days to weeks. And then an investor, you're looking at the week to month chart, and you're holding between months to years, and you're trying to capture big cycles. You're trying to catch the lowest of the low of the bear cycle and then hold all the way to the tippy top of the bull market. That's what you're looking for as an investor. When the lower time frame shows a reversal, but the higher time frame remains in trend, how do you decide when it's a real change or a pullback on the higher time frame? On the lower time frame, could just be noise, but you should, if you're a scalper and the short term noise is telling you it's going to go against your direction, then it shouldn't matter because you should have a good stop loss that it will stop you from losing too much. Now, if you don't have a good stop loss, then you're going to just wreck yourself. I when you're in when you're in scalp and the trade is moving against you, the emotion on the 1 minute chart is overwhelming. What's your personal mental trick or physical routine to zoom out in that moment and decide if it's just noise or reversals? We should take the emotions out of it. Your stop loss should save you or protect you from holding a trade too long. And we're gonna talk about that point, Hamid, in just a second, because I do have a note on that specific idea of like zooming in and zooming out to try to quote unquote cope with a market reversal. The young prof, a how does a trader's time frame choice influence the type of market patterns and signals they prioritize? I don't think it really changes it. It's more of like we just mentioned. If your time frame choice is scalper, you're looking at the second to minutes, but maybe taking a look at the day traders to get the general idea and then implementing that. For a long term investor who bases their direction on the weekly or monthly chart, how much attention should they pay to the rhythm on the day or 4 hour chart? Uh, well, yes, it is purely for entry timing, or it can signal potential change to the long term story. An investor isn't worried about the days, the weeks, the hours and the minutes. The thing is that like an amazing investor, like an A tier plus investor, will tell you, "Oh yeah, I time every single time I enter." But a great investor, like who isn't stressing out about every single dollar, like or trying to time the market every single time, what they're doing is DCA, dollar cost averaging. They're just setting up on Coinbase and Binance and saying, "Hey, every Friday, once I get my paycheck, put $100 into Bitcoin," and they're not worried about whether Bitcoin was up that day or Bitcoin was down that day. Investors are more generally just buying and buying, DCAing. DCA is king. Yep. For a long term investor, DCA is your best friend. Yes, of course, you can tell me, well, if I would have just, instead of putting $1,000 over 10 days, I just waited for the market to dip. Cool, but that means you're also spending a lot of time looking at the markets trying to get the best dollar, where other people are just saying, I'm setting it and forgetting it and going to make more money elsewhere. Emotion is out of it. Why might a swing trader interpret a chart differently from a scalper, even when analyzing the same asset? It's the idea of the picture, what the picture tells you depending on how zoomed in you are. If you're super zoomed in, you're looking at a different picture than someone who's zoomed out and seeing the full canvas. What factors what factors help you confirm that a short term move aligns with the strength and direction of higher time frame trend? Have you teach on confirmation, please? Yeah, so that is more talking about like your charting analysis and using your Fibonacci sequences. You're talking about your support and resistance trend lines. We've talked about all of those things in past to the moon events, all in like the base level. But me and Terrence have been discussing like maybe bringing some of those back to talk about like, hey, here's a recap of everything we've already covered. But now let's dive deeper into more advanced techniques on how to go ahead and make sure that your charting aligns with the strength and direction of timeframes. All right, I'm gonna move on to the next one here, and then I'll come back to some questions. But Thomas Benz, you were just asking about multi time frame analysis. So what happens when you start getting multiple directions, multiple? Hey, on this chart, on this time frame, it shows bullish. On these three, it shows bearish. On this other one, it shows bullish. Like, what do I decide? So the concept You look at 3 timeframes together to confirm direction, setup, and entry. For example, and this is for swing traders, we're talking about the 4 to 1 day charts. Higher time frames, 1 day chart, you establish the trend direction. So if you're going to be swing trading on the day chart, you would establish we are in a bull market, we are in an uptrend. In the middle time frame, you would go ahead and look at the 4 hour chart and find the structure. Okay, cool, we're in an uptrend. Are we close to a resistance line? Are we close to a support line? Are we in a pullback? Are we trading in a range? Are we trading sideways? Are we doing this? Or are we finding like a good pullback that we can take advantage of? And then in the lower time frame, you zoom in a little bit more. Now you're looking for the entry. You're looking for, okay, cool, I'm just gonna zoom in a little bit more, see if it's a good time to enter, and then zoom back out to just looking at the chart and the trade. Right? Simple rule to remember. So all this stuff is just like a culmination of everything we've talked about for the last half an hour, and it all could be said to trade with the higher time frame, enter with the lower one. So the higher time frame will tell you which direction to look for. The lower one will tell you when it's good to enter. Time frame conflicts and common mistakes. So this is where we talk about how do you avoid the pitfalls of trading. Mistake number one: treating all time frames as equal. If you guys walk away with anything, that should be the biggest thing, the biggest walk away. Not every time frame is the same. Just because you're a master of 1 second charts does not mean that you're going to be really good at trading on the daily chart or being an investor. If you're an investor and have held through some good, like some big dips and through FTX and Black Swan events, that does not necessarily mean you're going to be a good day trader. The time frames and the mentalities don't always correlate because they're telling you very different informations. So the time frame that we trade on depends on the strategy. Yep, that's exactly correct, Crib. Depends on what kind of trading style you have. And that's why it's like that's the beautiful part of trading and all, everything that we're learning. You decide exactly what you want. If you want to be a super degen and be on the second chart, that is totally fine. Like there's a whole strategy around it called scalping, and it's completely fine and completely doable. It's just more time intensive and more intention intensive. If you want to just be an
I
investor,
do want to say something on that point though. If you're looking at the second chart and you're betting against the trend, you're still most likely going to lose. Don't bet against the trend. Focus on the long term trend that's going. If the trend is up, if the trend is sideways, if the trend is down on the week or day chart, pay attention to that shit because it's going to affect your second chart, your minute chart. All of those charts are based off of the long term chart, depending on which way it's trending or whether it's breaking a different way or whatever on the week or day. That's going to affect what you're trading on the second because ultimately it can dip really hard if you're thinking it's going to long. It can long really hard, or pump really hard if you're thinking it's going to dip if you're betting against the trends.
that is very true, and that's why we talk about zoom out a little bit, get an idea of what the trend is looking like, and then zoom in and play. If you're just zoomed in and playing, you're just gambling, and nothing wrong with that. But just don't expect it to be a very profitable uh, way to become a trader. So that's mistake number one: assuming and treating all time frames as not equal. They all tell different things, and they all should be treated differently and adjusted to accordingly. Mistake number two: entering on a lower time frame that goes against the higher one. Exactly what Terrace just said. You don't want to go against the trade, against the trend. It's like when you shave. You don't want to go. You want actually that's not true. Shave. I've heard that you go against the grain. So not like shaving. The opposite of shaving. You you don't want to go against the trend. Right. Mistake
Wrong
number
analogy.
wrong analogy. Forget everything I just said. Delete it from your minds. The last 15 seconds were wrong. Mistake number three: switching time frames mid trade to cope. Thomas Benz, this is for what you were just talking about. That is not what you should be doing. You should not be switching time frames to cope. You shouldn't. and it's just it's hard to put it into words of like what this actually looks like. But we've all done it. We're like, oh my god, I am down 50% on this trade. How? Why didn't I put a stop loss? What was I thinking? No. Okay, let me zoom out. Okay, we're still generally in an uptrend. Oh, let me zoom out even more. Okay, it doesn't look that bad. But switching time frames to try to cope with your mistake that you made on the time frame that you're trading in, that's a big mistake. Always ensure that you have proper stop losses and that you're opening up your trades based on everything that we. How do you identify when a short trend is strong enough to trigger a genuine shift in the long term market direction? Dude, if you can figure out how to do that, you would be the best trader in the world. It's hard to predict. It's almost impossible to predict. To For anyone to really time the market and be like, okay, yep, we finally hit the peak. The bull market is over. 125 was the TP top for this one. Everyone else is coping. This is going to be the top, and now we're going to go back to like 70, 75, 60. If you can know how to do that, bro, you're going to be rich. There's That's the answer. There's no easy way to identify when the trend reversal is happening. You just continue trading with the trend until proven wrong. So if you're betting, there's no way that an investor always bats 100, because at some point in an uptrend, we start going down. And if you're following all your rules and you're being a disciplined trader, like if it's going like this and you're trading up, you're trading up, you're trading up, at some point you're gonna be trading up, and it hasn't hit your take profit, and now it starts going down, and you lose one trade. But now when the reversal happens, okay, maybe I won 5 trades and now I lost my first one, but that first one I lost it because it looks like we're in a trend reversal. You look for confirmation to see if we really are. It's almost impossible to know, okay, now we're going away from a bull market to a bear market, or we're going from a downtrend to an uptrend. It's really hard to tell unless you're the one manipulating the market. And if you are, I want to be your best friend, and I want to take you out for some coffee. James Benz, says you say to choose one time frame and stick to your trade. How do you define the main time frame? Is it where you get your bias, your signal, or both? It's where you get your style of trading. You stick to the time frame or frames because you can move around between, like a scalper is there are different kind of scalpers, right? You're a different scalper if you're on the 1 minute chart or if you're on the 5 minute chart, but it's just what you end up being more comfortable, and that's just based on you experimenting, trying it out. Like I've tried to be all these different traders, and I have found that the best ones for my style and from what I'm comfortable with are day trading when I want to be active, and investor when I just don't want to think about it. Like I'll just be completely transparent. Over the last like 3 4 weeks, I haven't really done that much day trading, and I'm glad because I would be pulling my hair out if I was. I just been I just been slowly just buying more during the dips and knowing that it could still go lower, but I hope that 5 6 years from now, this lower and lower won't matter because we'll be up a lot higher. So right now I'm in my investor mode because, and I'll tell you guys why. Right now it's a for me it's equally as plausible that the bull market continues in 2026, and it's equally plausible that the bull market ended when we hit 125 and now we're going into the bear market. And this would be the shittiest bull market ever because almost no one made money. So if that I'm preparing for both, and the way that I'm preparing is by just putting my investor hat and saying I'm just going to DCA and go ahead from there. Once I feel more confident about the trend direction, because right now we're moving sideways, as you guys saw, we're in this. It's so hard to decide whether we're going up or going down when it's all trading sideways. I am waiting for a decisive, okay, yep, the bull market is done. Start looking for shorts. For a decisive, nope, the bull market is not even started yet. We're going higher. I'm looking for a decisive move before I start going back to day trading. And now I'm just staying in and hoping for the market to give me a direction. And that's why that's what I mean by like you can be You can choose your time frames, but that doesn't mean that you have to be stuck to them because you could be multiple types of traders. Just to make sure that you use the right mindset and the right holding periods and the typical time frames for that kind of trader. Hope that made sense. Can I see the slide before this? Of course. This one will be dropped after. Yes, the whole slide, the whole slideshow and everything like this will be, and the recording. I know Maya, you were saying that you were having a hard time hearing me. This whole recording will be given to Terrace and uploaded here in the Discord, so you'll be able to watch it all back and hear all the shenanigans that I've been saying for the last 45 minutes. So fear not, all these things will be included. But that's pretty much everything that we have here. And now let's go ahead and we looked at this and at this. Okay, cool. So that's what we were talking about. That's mistake number three. Switching time frames mid trade is really where it's not good because now you're coping to try to say, okay, well, I opened up a long when I should really be looking at shorts, but if I zoom all the way out and look at the day chart, we're technically still in an uptrend. That's the wrong mentality because now you're trying to cope with a bad trade. You should just stick to those time frames for the kind of trader that you are in that specific instance. Mistake number four is using the same stop loss logic across all time frames. So, and I want to make it very clear because we were just talking about risk to reward ratio. That should be generally the same, regardless of the time frame. But the stop loss logic changes a little bit based on how you zoomed in you are. Because in the 1 second chart, and I wish I could just show you guys, in the 1 second chart, you're gonna be seeing a lot of this. A lot of this. And that means that your your stop loss should be put down a little bit lower to account for the noise. And the noise can sometimes and that's why it's so hard to trade on the 1 second and the minute chart because the noise will sometimes take your stop loss and just always hit it, even though you were right on in terms of the direction it was going to go. So your risk to reward ratio should still stay the same, and how much you're risking per trade should still stay the same. Please show us. Let me see if I can. 1 second. Let me see if I can pull up a chart real quick. Bitcoin. Bitcoin. So if we look at the day chart, it's easy to be able to decide stop loss and where you put them because you start looking at the wicks, you start looking at the bodies, and be able to generally decide, okay, cool, I'll just put my stop loss like a, just generally.
And, isn't TradingView, unless you have TradingView Pro, delayed by like 5 minutes or some shit?
Uh, I don't know if it's delayed by 5 minutes, but like I can't go to the second chart, but I can go ahead and show you the 5 second charts. I can't. I can show you the minute chart. Um, but I think the minute chart will also be able to explain what I'm saying. But the 1 second chart is the easiest because you will see a lot of noise. But I don't have the one. See if I can maybe.
Deck screener maybe.
Okay, this right here is a perfect
Jeez,
example of
look
what
at
noise.
those fucking wicks.
Yeah,
Oh my god.
this is a perfect example of what I mean by noise. And this is why stop loss can sometimes be really bad. Like if you were to open up a short around here, you're like, for whatever reason, right? This I'm not saying that this necessarily is a good time to open up a short, but if you do, and you're like, okay, well, I'll put my stop loss here because in most places I'll leave it there. When you get a noise candle like this, where it's just a big whale deciding to enter or leave a trade, it won't affect it. And if you just go up a little bit, like look on the 5 minute chart, it looks like every other candle. But look at this. This is what we mean by noise. Whatever happened at 3 a.m., like noise like this on the
Asia
more zoomed
woke
in
up
you
and
are,
aped in.
more zoomed in you are, the more you be affected by noise. And so it shouldn't affect your risk to reward ratio. If you're risking $10, you still risk $10. But it should change the way that you're where you're putting your stop losses to hope that you don't get hit by noise like that. And I'm glad that we found it so quickly. Like literally a couple seconds ago, this happened. A couple minutes ago. And that's just what I mean by noise. Like it won't happen all the time, but look at that massive noise. I don't think regardless of what kind of stop loss you would have, you wouldn't get hit by that. But it's more stuff like this, like these ones that are just like quick, super down, like. And I can guarantee you because I know I've seen this. This is someone got scalp botted. Someone became a sandwich. Someone had their slippage way too high and had it at like 40, 30% because they were trading some meme coins and then forgot to change their slippage and they got hit by an MEV bot. So I've seen this in a lot of tokens. So this is where you're like, oh man, I wanted to buy Bitcoin at 103, but I bought it at 103 and 5 because I had my slippage too high. It doesn't happen in Bitcoin too much, but oh, it's probably happened to some of you guys in meme coins or regular tokens. You have your slippage way too high, and then you get MEV botted and you get sandwiched, and you're like, what the heck? I put in $100 and I was supposed to get 1,000 coins, but because I had my slippage too high, I got 750 coins, and now you're really sad. And there's ways to protect yourself against that. Uh, Hoshigami, what is slippage? Slippage just pretty much means I can explain. It's outside of the scope of this, but I can explain it very quickly. Leverage. We had a whole event on leverage. It's to the moon 9 or 8 or 9. You should be able to look at the events here and all the recordings. We had a whole conversation on leverage, and so you'll be able to watch that back. Same thing. You'll be able to watch the video and look at the slideshow. But slippage just pretty much means when you open up a trade and you're trying to buy $100 worth of Bitcoin. Slippage is the amount of the percentage that you're willing to of price movement that you're willing to accept for the trade. I'll put that in an example. Let's just zoom out to 15 minutes. This is something that will help all of you guys. So I know this is not what we're generally talking about, but slippage is a really important concept to learn. Um, but for example, if you're trying to buy Bitcoin, damn it, yeah, 100,000 again. If you're trying to buy Bitcoin at 100,000 and you say I'm willing to accept 5% slippage, which is crazy for Bitcoin. Don't do 5% slippage on Bitcoin. That's a lot. You're willing to say I'm willing to buy Bitcoin at 100,000, but I'm willing to buy as low as 95,000. Just in case people there's a lot of movement and a lot of trading, you're willing to accept a small loss on what price you'd be getting in order to ensure that your trade goes through. And why that matters and why you would ever do that is because trading on most places works sort of like an open book. You are trying to buy Bitcoin. I'm trying to buy Bitcoin. Harris is trying to buy Bitcoin. We can't all buy it at the same time, and we can't all buy it at the same price because on the other side there's a seller. So if I'm trying to buy, it doesn't work necessarily the same with liquidity pools, but it works generally the same. But if I buy Bitcoin at 100,000, well, that's going to move up the price a little bit. That means that terrorists then would be buying Bitcoin at 101,000, and then the next person would be buying it at 102,000. So when everyone's trying to put a trade at the same time, slippage lets you be okay with a little bit of price movement to ensure that your trade goes. That's as simple as I can put it. But we can actually talk about slippage and liquidity pools for like a whole hour because that in itself is like a really, really important thing to learn and understand. Paris, let's buy Bitcoin. Yeah, at 100,000, dang man. I was happy. I'll tell you guys a little story. When the during the bear market, like what 2 years was it? 2 years? Like a year? Yeah, I think it was like 2 years ago when we were at like a 45,000 Bitcoin. I found out that from an old job, I still had like a 401k. I was like, oh crap! Like I have like a little bit of money from that 401k, and this is when the ETF had just come out. I said, well, I guess I'm just calling up the Fidelity and saying, hey, Fidelity, I know you're probably thinking I'm crazy. Throw it all on Bitcoin. and I was very happy because I, Bitcoin is at where it's a lot higher than 45,000. But I was telling all my
I remember recently when it dipped down to almost 20K. Remember, was that 2, 3 years ago?
hmm?
Not even. It like realistically, we've seen 20K prices in the last 2 to 3 years. So it could dip a lot lower than 100K here. It could continue its way down and then come back up. And I think a lot of that ends up. I'm big on the whole institutional money screwing with the markets because they do it on the main market. They push out short and long interests all the time. The only people that don't end up getting hugely affected by it are people that are just buying the stocks and holding them. It's the
Yep.
same thing with crypto. Now that they're all coming in with big money, like we've seen record high numbers of longs and shorts liquidated over the past what, m- 2 weeks, one
Yeah.
week, 5 days. Like, and institutional money is going to play into this more. And now that we've got an ETP coming out for like Solana and other chains, you're going to see it happening even more because they want to make more money on top of the money that's already being invested by their investors. They know how much money is being put where, so they can buy their personal amounts of a million Bitcoin because they're making all the money trading for other people. So like it it really it's crazy, dude. So you just gotta be careful. A dollar cost averaging like DCA is probably the best method to get into the market and earn over time. Toss it into staking. Toss it into make sure it's a safe protocol. Make sure it's something that you can trust. I personally love crypto.com. That's the exchange that I've been trading on forever. They're asset backed for all assets that are deposited into their ecosystem. So it's something that I have a little bit more of a trust level on. So what I do is if I'm holding something long term, I toss it on. You don't own your keys, you don't own your crypto, no shit. But at the same time, if you're doing it through Coinbase, who's becoming a giant in the space, or crypto.com, who in their own right are very is a very large exchange in the space, you're most likely going to be somewhat safe in putting that in there. Whereas like FTX was crazy. I don't think we'll ever see a repeat of that situation again in the market, but it's entirely possible. Somebody can fuck up. You know, this guy was like a nut job though when it came to like being free to fuck around with everybody's money as much as they want. Like that was insane to me. But I think most CEOs or owners of a company is going to try to be a little more responsible, especially after he got his ass thrown in jail. So I know I wouldn't want to go to jail for screwing around with things like that, you know? So I like just invest and take your chances with money you can afford to lose. Invest the money that you can't, that you need to put on the side. Toss it in 3 month staking. Get really nice yields. Polkadot. I have Cosmos, Avax. They've all got really good returns on staking from a lot of these big companies that whether they're CEXs, whether they're wallets. Wallets are coming up with staking protocols and shit now. You got so many different platform options that you can work with for this. You don't have to just degen and toss it into a perpetual or do 10x or 100x. That's for you to try to make quick flips, in my opinion. It's not for you to invest and hold. But yeah,
I agree. They're spitting bars. Love it. Uh, we
I
this
have the
is
knowledge. I just haven't been able to execute it. No.
Hey, you and me both, bro. Like I've been, and for me personally, it's just come down to discipline. Like I'll be disciplined for like 2 3 weeks. I'm like, okay, damn, bro. Like I did good this month, and then I'll start feeling, you know what, I might be the best trader alive, and then I start forgetting my rules, and then using too much leverage, and trying to revenge trade, and then trying to cope my trades. So all these mistakes are not just here because they're handy and dandy. These are mistakes that I've made myself throughout my journey, and that I continue to make because we're all
DJ.
humans. We're all humans, so we all make mistakes. We all feel these things. we all start thinking, okay, dang, I'm 10 for 10 this month. I must have switched something on, and then you start getting lazy and you start not doing all your rules, and you start. And this is just for me. I start not following everything to the T, and that's where I start losing. So if you can somehow take out all the emotion from it and just be a disciplined trader, that's you become successful.
See, my problem is I hold too long.
Oh yeah.
So like, yeah, I'll sit there and I'll like even on the second chart, I'll hold too long. Like I'll get in with like maybe $20 or something like that. I'll be at like a 30% profit, and I'll be like, it should still keep trending that way. It'll keep going, you know. And then it gets that one big dip, and it's like explodes. My freaking like my position's gone. You know.
Well,
Yes,
the,
greed.
the greed the greed is real. There are fixes to all these mistakes though. One, you gotta respect the higher time frame structure. If the 1 hour chart or in the daily chart is telling you we are in a downtrend, don't try to go to the minute and second chart and try to find uptrends. Like you'll maybe hit one or two, but you're just gonna be kicking yourself in the foot because you'll lose more often than. Don't over zoom to justify a bad trade. Don't go in and out thinking it's not that bad because if I zoom out a little bit more and I zoom out a little bit more, we're technically still in an uptrend. But like I
There's still a
decided,
chance
yeah,
it'll
there's
come
still a,
back.
yeah, it'll
Yeah.
turn around. It'll turn around.
I do that too sometimes. It's such a bad habit, but it's easy to do because you say, "Huh, you know what? It's not looking good right here, but let me just click this one button. Oh, it looks better. Great." You know,
Yeah.
it's not usually how it works, guys.
The final fix: choose one main time frame and trade. And my main time frame goes to this. Once you figure out your style, we can talk about like maybe we can have a whole event on like how to figure out what kind of style or what kind of trader you are. That's something that you guys would want to know because like I know I just pretty much like threw all these names at you guys. They're scalpers, day traders, swing traders, investors. You got to figure out what you are, and there's definitely ways to figure it out. And we talked about some of them here today. But if that's something you guys would find valuable and want to learn more about, try to figure out for yourself, we can definitely talk about that. But that's what I mean by choosing one time frame and sticking it to per trade. If you're opening up a scalping style trade, don't try to use swing trading logic or justifications to tell you that your scalping trade is okay. That's the fix.
Now, D Young had a good comment here. I do want to point that one out. How can traders maintain discipline and consistency when trading with multiple time frames without getting confused or overanalyzing? First off, you don't want to do the multiple time frames. Second off, maintain discipline and consistency. Set your expected take profit and set your expected stop loss. And if it hits your take profit, you've made money. And if it hits your stop loss, you've prevented yourself from blowing your account.
Exactly that. And now we're here to the final slide, the 60-second takeaway. 4 points that you should walk away from today. And I mean, we talked about a lot of other things that weren't in the slide, so it was a very juicy. But if you're gonna walk away with 4 things, these are the 4 things you want to walk away with. One, your trading style decides your time frame. I said that a lot of times. Depending on what kind of trader you want to be, that's gonna decide where you spend most of your time in. Two, every candle tells a different story. Always know which one you're reading. It's every candle and every time frame. If you're reading a 1 day candle, don't expect that to tell you everything that's happening on the 1 minute chart. Make sure that you know what you're reading and understand that it may not be the same story when you zoom in or you zoom. Three, use 3 time frames. And by 3 time frames, I know I mentioned because Hamas was asking, oh, how should you look at it? And I said you look one style up. One style up does equal 3 time frames for the most part. You're on the 1 minute, you're on the 1 second chart. You look at the 5 minute chart, and then you look at the 1 hour or 4 hour charts. You look a little bit higher up from where you're trading to come up with that. Use 3 time frames. Top is your trend. Your day will tell you the trend. The middle is where you're looking for the setup. You zoom into the 15-minute chart or the 1 hour chart, and then the bottom is your entry. So you set your trend on the 1 day, for example. You look for the setup on the 1 hour, then you look for an entry on the 15 minutes. That's a pretty good, really good. Most of the time, more than I do a lot of times because I'm still working on my discipline. This will help you out tremendously. And four, never, ever, never, ever, ever, ever trade against a higher time frames direction. You might succeed, and I say never ever, but I still do because I'm a degen and I'm a gambler and I do crazy stuff. But you should try to never trade against a higher time frames direction. If you do all those things and you're disciplining yourself, it's a winning strategy. Thank you
Never say
guys.
never. I do it all the time. No. But that's also why I'm in the negative.
Yep. That's and it's easy to read it on paper and say it out loud, but to put it into action and actually start doing it, that's what differentiates people who are amazing traders and people who are still starting out. And although I feel like I'm a good trader at times, I still have the same pitfalls. I still make the same mistakes. And it's just us. We're getting better. We're all growing together. So that's it for me here today. I
Exactly.
appreciate you guys coming out. And I know this was a jam packed one. I know there were some people with a couple audio issues. Don't worry, the recording is just